Hi, everyone. Welcome to our webinar today. We have quite a few people trickling in, so we're going to give everybody just maybe 30 more seconds to roll into the Zoom, and then we will get started with our panel. Thanks for joining. And if you would like to share with us where you are located in the chat, I'm dialing in from Houston, Texas. So let us know in the chat where you're from. We'd love to hear from you. Oops, I had the chat disabled again. So just turned it right back on. So you're in now. There we go. We've got lots of folks. I see England, I see New Jersey, Oregon, Florida, Georgia, Oregon, all the coasts represented here. So welcome. All right, well, it looks like we are starting to see a lot of folks settling in. So we'll go ahead and get things started. So today's webinar is all about talking about whether a credit crunch might be on the horizon. Lots of things going on in the macroeconomy. So we want to talk about what CFOs can do to prepare. So we've assembled an awesome panel. It's going to be a great session. So be sure to let us know in the chat again if you would like to let us know where you're dialing in from, and then be sure to submit questions if you have any to our panel. Before we start, first thing is that we are recording today's session, so we will make a copy of the archive available on demand if you want to share it with a coworker, or if you miss any part of today's session, we're happy to give you a copy of that recording. You'll have that in your email inbox in the next day or two. Second is that if you are here for CPE credit through CPA Academy, the polls are required. So be sure to respond to those as we launch them. They'll be sprinkled throughout the session. And then lastly, like I said, we're on chat and Q&A. Love to keep the conversation going here. So be sure to submit your questions for the panel in the Q&A. And if you want to chat with other folks on the call, you can do that in the chat. You can also, if you see another person ask a question in the Q&A that looks interesting, be sure to upvote it, and we'll prioritize some of the most popular questions. So with that, I did want to just quickly introduce our panel. Like I said, we've assembled a panel of financial experts from a lot of different perspectives here. So the first is BC Krishna. He's the founder and CEO here at Santeam. I forgot to mention, I'm Allie. I'll be moderating today's session. I'm also with Santeam. But BC, you want to say hi and tell us a little bit about your perspective today?
Sure. Hello, everybody. How are you doing? My name is BC Krishna, and what I'd like to do is, not to jump too far ahead, share with you a little bit of data from some Federal Reserve Bank surveys that hopefully tease this up for you. Sorry, Ali, you're going. I should have remembered this. Are you doing all the introductions first, or should I just dive right in?
No, we'll do all the introductions first.
Yeah.
No problem. Yeah, so we'll go to Chris next. So Chris is the CFO at IntelliCare. Thanks for joining us, Chris.
Thanks for having me, Ali. So happy to be on the panel today. As Ali mentioned, I'm CFO of a company called IntelliCare, which is a digital health business, more specifically a platform that enables flexible work for nurses. So an application that matches nurses with healthcare providers who have needs for per diem nurses. So happy to be on the panel and looking forward to the conversation.
Awesome. All right. And then from First National Bank FNBO here, we have Carrie Zuha, who's the VP of Commercial Payments. Welcome, Carrie.
Thanks, Ali. Good afternoon, everyone. BC Ali, thank you for having me today. I'm super excited to be here. As Ali said, Carrie Zuha, Vice President of Commercial Payments at FNBO. I manage our strategic partnership with Santeam. So FNBO is not only a reseller, but we also power the working capital and banking solutions that are embedded in the software. So I think the perspective I bring today is more from a commercial payments or treasury team on how we can bring cash management solutions to companies to really help them thrive regardless of the environment or economic pressures that might be at play.
Awesome. Thanks for joining us, Carrie. And then a late addition to our panel is Philip Pilkington, who's a macroeconomist. We saw an article in Newsweek that he wrote about some predictions around the credit crunch, and we said we got to have him on the panel. So Philip, you wanna say hi?
Hi, everyone. Yeah, my name's Philip Pilkington. I'm a macroeconomist based in England at the moment. I worked in finance for about 10 years. And yes, I've been writing recently on the credit cycle because I think there's some interesting things going on in the banking system.
Awesome. Well, I can't wait.
And there's no webinar is complete without having a person with a British accent, of course.
that was an added perk that we didn't know we were going to get.
Added perk.
So that's great. Well, it's awesome. We have, like I said, lots of perspectives here and can't wait to get the conversation started. But just to tease a little bit of what we're going to cover today. So the agenda is we'll talk a little bit about, what those predictions are around whether a credit crunch is coming. We've got some stats to share. And then we'll really spend a lot of the conversation around actionable tips for what CFOs can do now to prepare. We really want to arm you with some things that you can walk away with today to put into practice in preparation for the potential for a squeeze. And we'll also give you some suggestions for solutions for how to do that. And then, like I said, there'll be some audience Q&A at the end. So you can go ahead and submit those questions now. But I think we're ready to actually transition into the panel discussion. So let me pull up my questions. I think we're going to start with BC. So you've been watching all this really closely. What signs are economists pointing to that suggest a crunch could be coming? Let's start there.
Yeah, so what I did in preparation, Ali, is I thought it would be helpful to go and pull some data from the Federal Reserve Bank. As you all know, the US Federal Reserve Bank tracks this kind of stuff very closely, lots of indicators of macroeconomic kind of performance and also specifics around the credit environment. And I thought it would be good to just really start with a really important survey that the Federal Reserve Bank does once a quarter. This is a survey that goes with the extremely arcane title of the Federal Reserve Senior Loan Officer Opinion Survey. And it's a survey that is once a quarter of bankers, credit officers at banks. And this chart, is really indicative of the current, and again, everything that you see here it requires like 15 minutes of explanation. I'll try to resist. But, essentially, this is a sentiment on the part of the loan officers as it relates to the current lending environment. Just in terms of the overall graph, you can see that if the graph dips down, it means they feel good about lending. If the graph dips up, it means they don't feel so good about lending. And you can see there are 4 peaks within the last 35, 40 years or so that are worth pointing out. There's one peak here in terms of when the sentiment is bearish, and that revolves around the internet bubble and 9/11. About 12, 15 years later is the 2008 mortgage crisis. Of course, that caused major havoc. Another 15 years or so, and you had this kind of unprecedented COVID pandemic. And then, you can see what's interesting about this, and in a minute, I'll turn it over to Philip to share his perspective on it. There's a period of time between these peaks and valleys. But what's happening here, as you can see past the COVID pandemic, is that there's this sort of 2-year period, about 1.5-year period, where the sentiment turns very bearish. And this particular survey captures the sentiment from April 2023, which shows that in the wake of not only the SVB failure, but certainly what we have right now is a very bearish sentiment, as the data shows. If I was to put it into words, again, I'm going to pull a quote from this particular report, which, by the way, you can look for and read yourself. But this quote is really interesting, right? Basically, what it says is that over the remainder of 2023, banks reported expecting a tightening standard, expected deterioration in credit quality, and overall a reduction in risk tolerance, concerns about bank funding costs, that is, interest rates are higher, bank liquidity positions. That is, that regulators are looking at those ratios between how much reserves they have and how much they lend very closely, and deposit outflows, which is, of course, one of the outcomes of what happened with Silicon Valley Bank, where you had like many banks, not all, but some banks certainly experienced an outflow of deposits. So all of this is really contributing to the tightening lending standards in the rest of 2023. If that doesn't point to some kind of credit crunch, I don't know what else does. Because after all, most of the time we're borrowing from banks. And so what I'm going to do is to actually just highlight the last year and 18 months or so, Philip, because I think you've written about this and you've talked about how this thing comes in cycles. So share your perspective, please, on this topic.
Yeah, thanks, VC. I think definitely this report, which is sometimes called the SLOOS report, is the key data point to be looking at. It comes against a background of kind of, I mean, everyone knows it now, tightening, high inflation, tightening rate cycle from the Federal Reserve. This tends to mean the end of a credit cycle. Just to kind of explain what a credit cycle is, it's kind of it's a cycle that the economy tends to go through. It starts usually at the bottom of a recession. At this point, the Federal Reserve will usually lower rates. It will sometimes do extraordinary policies like quantitative easing. The idea is to flush the banking system with funds to be able to loan. So at this point, you know, economic activity is quite low. People aren't borrowing that much. And a lot of credit is turned on. The kind of tap is turned on. After that, in the second recovery phase, people start borrowing. Borrowing standards are still loose, but people are still conservative in their borrowing. And things are getting back on track. Then in the third phase, I think there might be a little bit of over borrowing, a little bit of overspending. Money goes into more risky corners. I think we've seen that after the COVID pandemic. Really, we saw a period of that, and often in the third phase, you'll start to see prices creep up, inflation get quite bad because the economic cycle gets quite hot. And then we enter the fourth cycle, which is for interest rates to rise. Banks to become quite conservative. Often you can see bank failures at this point, which of course we've seen a few bank failures in the United States in the past few months. And at that point, credit standards will start to tighten. Banks will start to rein in lending. They'll be far more conservative with their borrowing. Borrowers themselves will be more conservative. And if you look at the breakdown in the recent SLOOS report, you see a contraction both from banks providing liquidity and lending, and also from borrowers asking or receiving liquidity and lending. So a lot of both the SLOOS report itself, the data that BC is showing, and the general background, you know, the ambient noise we hear around markets right now seems to be pointing in the direction of a credit crunch. How long will that be? I mean, no one can say for sure. I'd say the bond markets at the moment are positioning themselves that it's quite close. And the stock market and hedge funds and so on are saying we're probably a few months out, maybe 6 months, but no one really knows. But I think the key information is that we're now at a very tight point in the cycle, and the next phase is probably some sort of a crunch, as BC said.
And so would you bet on it?
With my own money, I'd be careful of it. I would definitely be taking out an insurance policy right now. That's how I think about it.
Always wise to be careful, right?
You'd hope so, yeah.
Yeah, so let's take it to Carrie. We're 2 months removed from SVB failure, like Philip said. From a bank's perspective, like what are you seeing out there? What are you hearing from clients?
You know, I'll speak first from the bank standpoint, where I think we're uniquely positioned as a regional bank. So for background, we're a 165-year-old privately held bank and located in the Midwest. We're on our 6th generation of ownership. For us, we have a really strong balance sheet and stable, diverse deposit base that's spread across, many businesses of all sizes and highly varied industries. Whereas the recent bank failures, they have very different portfolios and concentrations than we do. So I think for FNBO, it's really just business as usual for us. We will continue to do what we always do, and that is serve our customers with passion. I really just want to speak from FNBO. That's just who we are. And, we're just going to continue to operate as we always do and serve our customers where they have needs.
Love it. And what about you, Chris? So you're representing the voice of a CFO inside of a business right now. Like, is this something that you're concerned about? What are you thinking about right now?
Yeah, I would say that in general, it's concerning for CFOs broadly, right? I mean, I don't need to speak to the specifics of my company, but anytime access to capital becomes more constrained, it just makes for a harder operating environment, particularly in the SMB part of the economy, right? I mean, this is where businesses probably don't have as robust of cash flow as the S&P 500 constituents. And so, the credit markets, I think some people know, but many probably don't, are multiple sizes of the equity market. So most of the capital in the ecosystem is coming from these credit markets. And so, if companies haven't thought about this well enough in advance to be prepared, I think it's going to be some turbulent times ahead. So generally speaking, on behalf of CFOs, I think it makes for a much more challenging environment over the foreseeable future.
Yeah.
Chris,
so-
can I just ask you a sort of completely dumb question?
I would expect nothing less, but go ahead.
How do I take that? You expect dumb questions from me? Is that the story?
No comment. Just on with the question.
So, I mean, I think the sort of general point is, do you as a CFO pay attention to this sort of stuff? Or do you see this, being careful with cash as just business as usual? I mean, there are sort of, you can look at it both ways, right? There are people who, will only take the painkillers when they feel this sort of sharp pain in their, in their plantar fascia, and other people just, really kind of run carefully all the time.
Yeah.
What's your sort of view on things, and why would you be influenced one way or the other?
Well, I think part of the job is thinking mid to long term, right? And so being aware that things like this can happen. And yes, part of the job is being disciplined around cost structure, working capital management, and the like. But the reality is when capital's cheap, like it has been, debt and equity for an extended period of time, you lose some of that discipline around the operations. And I mean, I think you see that happening across the economy now with layoffs at companies of all sizes and the like. So, the short answer is you should always, as a CFO, kind of best practice, keep an eye on both. But the reality is it's a tough job. There's lots of things to focus on every day. And when capital's abundant, it seems like there's no end in sight for, when times are going to get tougher, then you kind of get comfortable operating in an easier environment. So, and I have more on this for other parts of the webinar and kind of how things, the pendulum swings. But it's you need to be focused, in particular times like this, on the macro environment and what's likely to happen. And often, and I'll talk about this a little bit later, it's like it behooves you to focus on it, because by the time it becomes a problem, it may in some cases be too late to act, or at least access all of the different levers and options you have. So
yeah, so we just actually asked the audience how concerned they are, and it looks like about 93% of the audience says that they are at least somewhat concerned about a credit crunch. So not surprising that this is top of mind for everyone. It sounds like some people didn't miss the poll, so I'm going to reopen it for y'all while we jump into the next question. So we'll keep that going, but I'm actually going to also take it back to Philip, right? So if we somewhat agree that a credit crunch is pretty likely, what are the implications for small businesses? We're specifically talking to small to mid-size CFOs today. So talk to us about what's in it for them.
Yeah, I think a lot of what Chris said is correct. In times of easy money, you come to expect easy money. And I'd say the times since 2008 have been the times of some of the easiest money seen actually in US history. The quantitative easing programs have driven yields down on lending across the board. They flooded the banking system with so much cash that the banks want to lend infinitely, as it were. And in a time like that, it can be cut. You You can be looking at credit sources and so on that you think, well, this will be here forever. They seem to want us to lend and everything like that. But when the credit cycle turns, those lending sources can often tighten up. Money won't be as easy anymore. The Federal Reserve, I mean, when they're raising interest rates, they are literally extracting money from the banking system. That's how they raise the rates, and they replace it with government bonds. So I think I'd really just emphasize Chris's point that lending that you may have seen as being easy, as being almost like trying to be sold to you in a sense, may become a lot more difficult to get. It won't last forever, but the tightening phase of the credit crunch can last, anywhere from 12, 18, 24 months. And frankly, no one knows how tight it will get until after the fact. I think that's what to emphasize. So a lot of uncertainty, I think it raises for people who are relying on lines of capital and borrowing.
Yeah, so with uncertainty ahead, I think the next big topic that we want to dive into as a panel is really that what can you do as a CFO to prepare? So I think I would like to start with Chris. You are a CFO. Like, what are you doing to prepare? What are you thinking about ahead of something like this?
Yeah, so I mean, good segue from where I left it off with BC's question, but at a high level, when you think about the sources of capital for businesses, it's from your operations, it's from debt, and it's from equity, and that's kind of an ascending order of cost of capital. We just had the conversation, and Philip reiterated that when debt and equity are cheap, then lots of companies that maybe otherwise wouldn't have access are tapping into them. And then literally, Philip mentioned this, you have people coming to companies basically begging them to take this capital because it helps them kind of earn their returns. And so during those times, I think the pendulum and discipline swings away from the operational aspect. And so the number one thing to do when you get to this point in the cycle, and ideally a little bit ahead of it, is to make sure you're focused on that operational aspect, because while it's not entirely in your control, it's certainly more in control than the other sources of capital. And so, what are some things that you can do to really focus on the operational piece? One is understanding the business cost structure. I think folks get this. We've seen this in headlines for the last several months about companies making sure that they're getting appropriate returns on their investment and their cost structure and adjusting accordingly. The other thing that maybe is not quite as obvious is the amount of interdependencies between all of this, right? So when you look at a credit crunch coming, the broader implications on the economy, when you think about credit as the lifeblood of the economy, you need to be thinking about what could happen to your revenue in a recession or worse. And so when you think about the cost structure of your business, one thing I see that businesses do all too often is like, okay, well, we're going to adjust our cost structure for where we are today, but then we're going to start growing again, or it's going to be run rate. So really sensitizing, understanding the different scenarios that can play out so you're prepared, and then making sure that you have the ability to fund those various scenarios. And so some of that will get to credit, which we can talk more about, but the cash cycle part of the business. So there's a cost structure, and then there's how you're managing your receivables, how you're managing your payables, become incredibly important. In a lot of cases, just shaving a few days off your cash cycle can really make a big difference and help you weather the volatility in your cash cycle over a longer period of time. The last thing, and this is maybe too little too late today, maybe not, but it's always wise, and Philip kind of mentioned insurance earlier about the potential credit crunch. I think of having debt capacity, even if you don't need it, in the form of a revolver or credit facility, as that insurance, right? So, I mean, I can, in this case, use my company as an example. I mean, we carry a credit facility that has available borrowings, but nothing drawn on it. And, we have to pay for that, but view that payment as insurance against when credit becomes tougher to access. And so, certainly advise folks to, think about that and having that, because again, to the discussion we've had earlier, when capital's abundant and cheap, you don't necessarily think you want to be paying fees for something that you're not going to use, but things tighten, and they tighten quickly. It can be nice to have that. So those are just a few things that come to mind on ways to kind of prepare and be ready for this scenario.
You know, and what you point out, Chris, I think a couple of people are making this point in the chat that, you know, if you have leverage, you may well, you know, ask for extended payment terms from your suppliers. And, you know, of course, that has a huge impact on your working capital. And the other side of it is, of course, on the receivable side, if you can squeeze a few days off of that, then certainly you get, you know, more impact there as well.
Yeah.
I think this is your point, right? It's in some ways the cheapest way to unlock cash that you might actually already have on your balance sheet.
Yeah, absolutely. I mean, managing your operations and your own cash cycle is the most in your control. And I mean, I make the point to say that it's not completely in your control because you can't control your counterparties and you can't control the broader economy as an individual firm, but you can certainly do more about that stuff than potentially, you know, having to get capital from someone else. So, you know, there was a question somewhere in the kind of prep for this on what you can kind of do to avoid a credit crunch. And I don't think any individual firm can steer an economy away from a credit crunch. But the flip side of what you just said, BC, is if everyone starts extending terms and stretching things out, I mean, that has adverse impacts on the overall economy too. So we need to be careful to not to use kind of a corollary like a bank run. If everyone gets super conservative, then it actually ends up becoming a self-fulfilling prophecy. So, you know, just a word of caution from going too far.
Some of you have been on past webinars with me and Chris know that we used to work together. And, you know, this is probably a good time for me to talk about, like, you know, the spring of 2019, when you and I, like, you know, faced a situation where we had to, like, you know, do whatever it took, you know, to add working capital. And those things were did, right? I mean, I think if you have leverage, and not everybody has leverage, if you have leverage, that's what you're going to try. And sometimes it's not about extending payment terms. It's about just really often on the receivable side, you know, being paid on time, you know, not necessarily being paid faster, you know.
Absolutely.
Yeah, and I launched a poll, if in case anybody missed it, specifically asking about, you know, these operational type things. Do you have the tools that you need to deal with those? And so far, you know, it looks like very few, a small minority feel that they have like the ideal tools for that. So we'll get into some solutions here in just a little bit, but maybe I can throw it back to Carrie from here to talk a little bit about what are you telling clients to do differently in preparation for something like this or in this current climate?
Yeah. You know, I don't know if it's about doing things differently. I think it's about just thinking about your business and what's the best way to operate. So one thing I think that's overlooked is really making sure, especially for small to mid-sized businesses, make sure you have a relation established with a trusted partner at your bank or whatever FI that you work with, whether that's a relationship manager, lender, banker, treasury officer. You know, every bank has their own naming conventions, but it really does make a difference when we know who you are and what type of business you have, your ebbs and flows. And having that open communication is going to be key when needing to discuss your company's performance or any headwinds. So if anything, you know, get a trusted partner at your financial institution. Next, you know, is really shoring up your liquidity. Make sure you have enough cash for any unexpected short-term costs, losses, or expenses that might happen. Also have enough cash to seize on opportunities. Sometimes in these environments, that's the best time to seize on opportunities as well. So really thinking about your cash and cash flow and how to really optimize that. And then finally, really, I'm not on the credit side of the bank, I'm on the payment side, you know, the treasury side. So for us, it's always helping companies look for ways to monitor and manage your working capital. I think Chris mentioned it earlier. This is the time to think about streamlining your operations. How do you find ways to unlock cash in either your receivables or your payables? You know, solutions like Centime, and I think in a little bit here, BC is going to get more into it, but that is exactly what they can help companies do. And so another reason why we partnered with them so that we can bring solutions like this to companies.
That's great. And then, so going back to Philip, you know, from a macro standpoint, are there factors here that CFOs can control? Like, what do you recommend focusing on in this moment?
Yeah, I mean, I think one thing to keep an eye on, obviously, we've seen a few bank failures. I don't think we need to be hysterical about the entire system falling apart or anything, but clearly there are some vulnerable banks We've had very low interest rates. Again, I'll stress quantitative easing programs and so on. These are experimental measures. They haven't really been tried, at least in the United States, prior to 2008. I think what we've learned from the past few months of Silicon Valley Bank, First Republic, Signature, and so on, is that especially small and medium-sized companies tend to have cash balances that are larger than the FDIC insurance limits, which is $250,000 still, hasn't been changed. Now, of course, the Silicon Valley Bank depositors were actually bailed out by the FDIC, but you probably don't want to be put in a position. I'd say they had a very stressful few days before that was announced. So it seems to be a pretty good idea to try and find a solution to having excess deposits guaranteed. That's probably really good peace of mind. If I had a very large amount of capital, working capital sitting in a bank, I'd probably want that insured. And then you don't have to kind of rely on the political waves, because a lot of the bailouts, if there are more of them, what we saw in 2008, 2009, they tend to become a hot button political topic. And I think everyone knows that they don't want their business tied to any political topic in DC. It's highly uncertain. You don't want that stress. So I think really the thing that you can control most right now, looking at the macro environment, is to try and make sure that any excess deposits are guaranteed in some way.
Yeah, so that's a great segue into our discussion of solutions. So we are doing really good on time, BC. So I'll throw it to you to talk about, what Santim has been working on and what are some of the ways to practice.
Absolutely. A couple of things I just wanted to say before I launch into that. I think the kind of recurring theme here is to just really focus on what you can control. Advice that my mom gave to me when I was like a small child. And it's something that I think one of the points that that Philip is making is that not only do you have to look at how you shore up your operations to ensure that you have good working capital discipline, but also to make sure that the cash that you do have is properly protected. I know that, Chris, you've done some work at your firm to ensure that you've diversified your deposits as well. So I'm going to share my screen. Are you still hearing me? Did I go on mute or something? No.
Yes. No, we can hear you.
Okay. So I'm going to share my screen and very quickly walk through some of the operational things that Chris talked about. Of course, I'm going to do it in the context of, the solutions that Santim provides. But please view this as a case in point, an example of the types of things that, you should do. Obviously, we'd love for you to engage with us to see how we can help, but that is, certainly something that you ought to be able to do yourself. So the whole point is, what are your financial operations look like, and what elements of your financial operations can you focus on to boost cash? There are some things that are obvious, but not necessarily always so. I'll start by just simply saying that it's always good to know how much cash you have. Many businesses bank with more than one bank. And having a kind of a view into your assets and liabilities seems like a very basic thing, but getting that into that operational rhythm, the discipline of saying what are my assets, what are my liabilities, what are my credit card balances, what are my lines of credit, where are my checking, savings accounts, etc. It's just really basic and important. Going from there, it's what am I forecasting, right? So what is it that my forecast looks like? What are the inflows and outflows and so forth, right? I mean, just how much cash do I have? How long is it going to last? Basic stuff. But there are three levers that I think of as the operational levers that Chris talked about, right? Accounts receivable, accounts payable, and credit. These three levers help you really control how much cash you have. So let's just focus on accounts receivable. And one key metric here is a metric that some of you may be familiar with, which is called days sales outstanding. Simplistically, it's like the number of days that it takes for a company to collect cash against outstanding receivables. The smaller your DSOs, the better you are, right? Because that simply means you're collecting cash. You don't have cash locked up in receivables. And this chart is pretty amazing, right? Because what it tells you is these are all, legacy, large-scale manufacturing companies, and you can see how carefully and how well Tesla manages its DSOs. it's dramatically different, compared to it's in the, few days as opposed to the other legacy, auto manufacturers. So anytime you keep your DSOs low, it simply means you don't have cash locked up, your receivables locked up, and you can collect. That's always a good thing. The flip side of managing AR to reduce your DSOs is to extend your days payables outstanding. This is a headline from today's Washington Post, and many of you on the chat have commented on it. At some point, everybody is going to have to ask their suppliers to either change payment terms or to push payables out. And pushing payables out extends your days payables outstanding. Extending your days payables outstanding means that you have more working capital. And more working capital, of course, means that your liquidity is improved. Very basic. I think a lot of times, like, we tend to think about accounts receivable and accounts payable as important processes, and a lot of efficiency is what people focus on. But beyond efficiency, the idea of AP and AR actually influencing working capital is often underrepresented. And what I wanted to do is to also show you this. There's an outfit called the National Center for the Middle Market. You can search online. And on their website is a little calculator that tells you what the impact is likely to be on your working capital by managing your AP and AR. So what I did was I plugged in on their website a hypothetical $10 million manufacturing company with a 45-day AR, which is not atypical, and a 30-day AP, again, not atypical. And you can see their calculator tells you what the impact is going to be of improving AP and AR. A single day improvement, and you can see like how much of an impact the AR has, right? A single day improvement in accounts receivable gives you about $27,000, $28,000 worth of cash. And just 5 days of AR improvement, extending your, reducing your DSOs by 5 days, from 45 days, let's say, to 40 days or 30 days, right? And 30-day receivables is not out of the question, right? It's pretty standard. And so you can see what a massive impact it has. And we have seen this kind of impact in real life with our customers. One of our customers actually unlocked something like $1 million in cash by simply managing their receivables more effectively. So it's really important. I just wanted to sort of highlight the fact that AP and AR are both important levers to help release unlocked cash that's sitting on your balance sheet. But you just have to manage it more effectively. But sometimes it's maybe I'll just say as a kind of a summary of what it is that we do. We do have a solution that we call Centime Cash Management. It has these 4 things that we just talked about: the ability to look at your cash in aggregate, forecast, manage AP by providing you visibility into your cash and forecast, managing AR by providing you visibility into your cash and forecast as well. So that's kind of, an important element of it. But we're here talking about the credit cycle and the credit crunch. And if it turns out that you can release the cash that you need by managing AP and AR, more power to you. But as Chris also said, it's never a bad idea to have some kind of credit facility that you can tap into when you need it, right? US government, other people always find themselves sometimes in a situation where things get uncomfortable. When things get uncomfortable and you're not able to control, AP, AR, then you might need to tap into credit. And that's one of the reasons we have worked with FNBO to actually create this credit facility that, we'll talk about in a second. But before I actually talk about it, I just thought that, the Federal Reserve, as I've said before, is an incredible source of some really insightful information about how businesses borrow. And I wanted to share with you a few thoughts from a survey that they do. Again, this is an annual survey that the Federal Reserve does on small business lending. So I've just pulled a few data points and charts from that Federal Reserve survey. You can also find it online. As you can see, businesses routinely apply for credit. The last 2 years have been a little bit of an anomaly, but if you look at the survey and going back a few more years, it's about 40% of all businesses typically apply for credit. Of course, when the pandemic hit, we've had this problem. People believe that, it's slowly recovering. Again, the credit crunch may impact it, but it's down a little bit in terms of businesses applying for credit. But somewhere between 30 and 40% of all businesses apply for credit every year, which is a very meaningful amount. And so and why are they borrowing, right? This is a remarkable chart to me. You can see that, as of 2019, when the economy was robust and interest rates were really low, about 56% of all businesses applied for credit to expand the business, and about 40%, 43% of them applied for credit to meet operating expenses. But this has dramatically changed. In 2021, you can see it was less about expansion and much more about meeting operating expenses. Back to Chris's point, when you're in this cycle, it just really is about making sure that you have the liquidity that you need to meet your working capital needs, right? Wages, rent, inventory, things like that. Running the business, BAU. Most applications are less than $1 million. Businesses are not applying for like $100 million loans or $5 million loans or relatively modest amounts of cash. Again, in keeping with the fact that these are sort of short-term borrowings to meet working capital needs, to meet operating needs that businesses have. Again, there are many different types of credit, but again, highlighting the fact that most of the time it's a short-term loan or a line of credit that applicants are seeking. Where are they applying? I mean, of course, we all tend to think of like banks as the ones that are typically the sources of credit. But in the last few years, you can also see that the online lenders, Kabbage, OnDeck, Bluevine, have been sources of credit, right? And one of the reasons why many smaller businesses have turned to online lenders, is because they may not have a very robust, credit picture, high risk portfolios, in other words. So it's a pretty amazing story if you think about it, that most businesses typically apply to banks and online lenders. Now, the story gets a little bit more interesting from there, right? Because what happens is that obviously these are sources of credit, but banks and online lenders both face challenges. Banks are, of course, robust. Kerry talked about FNBO been around for 165 years. And going along with that is the fact that sometimes the application process can be difficult. Sometimes it might have to be a conservative process that you have to wait for a long time for a decision. The flip side of that is that the online lenders, while they may be quick to make decisions, one of the reasons why is because they take a lot of risk, and they have, whereas the bank might charge a lower interest rate, these guys run around 36, 37% APR. Their payment terms are also relatively unfavorable. So there's pluses and minuses with each. And so as we looked at the opportunity to, really help businesses get the credit that they were looking for, we thought it would be a good idea, to really kind of consider what the best of both worlds might be. So we have partnered with FNBO to actually bring together the stability and the robustness of what a 165-year-old bank brings to the table, with the innovation and the currency that our company has created in sort of speeding up the decision-making process, simplifying the credit applications, and designing a product that actually ultimately provides better payment terms. So that's kind of what we have done, and part of what we announced today is a credit facility. It's a working capital credit facility. In a minute, what I'd like to do is, do we have some 2 or 3 minutes, Ali, for me to just really walk through a quick product demo?
Absolutely. Yep.
So what I'd like to do is to just really highlight, the fact that, we have brought together the components that rely on the strength of FNBO's balance sheet, conservativeness, stability, with our own sort of ability to create a fintech solution that, makes it easy for businesses to actually borrow and use. So there are many elements of this, but let me just jump to a quick demo, and I can show you what this looks like. You're looking at the Centene cash management solution, which has many different modules, forecasting, KPIs to understand where your cash is, receivables and payables. But when you're managing your cash, as I said, this is your current cash picture. But let's say I'm now interested in, let's say a $20,000, loan drawn from my line of credit for 60 days, right? So it's very simple. What you do is you click on this button. You can see the company, we present to you your forecast over the next several months, what your cash flow looks like. And then drawing from this credit line is as simple as choosing the account that you want to move the money to. These are your existing bank accounts. We're not requiring to do anything else. You specify the amount you want to borrow. Let's say I want to borrow $20,000. And effectively what this does is it shows you how your cash position changes as a result. And your payback period, right? You know, the facility that we have created, you have at least, not at least, you have up to 90 days within which to pay back, but you don't have to take all 90 days. Let's say I need it only for 30 days. And so I have a 30-day payback period. And once I do that, then, I have the cash that I need. And once I kind of hit the withdraw button, the money gets moved into your bank account, and that's pretty much it. So that's kind of what we have designed with FNBO. It's a really simple capability. You apply for it online. It's something that let me just go back to my slide deck here. It's a 90-day payback period. The amount of credit is based on your need and your financials, but it might be $100,000, $200,000 order of magnitude, something like that. It's a simple online application. A credit decision in 2 business days. We're obviously working very closely with FNBO to see how much we can shave that. There are no application fees, no origination fees, no prepayment penalties. The way the fee structure works is that it's a small daily fee that's assessed against the open balance. If you maintain an open balance, you pay. If you don't have an open balance, you don't pay. But as Chris said, the facility is always there for you to draw on. You can draw cash for as little as a couple of days or as much as 90 days based on your need. And as you draw, we give you full transparency into the cost of capital. So those are the major elements of it. Carrie, do you concur? Do you agree? Is there anything else that, we work very closely with you on this? Any thoughts that you have on it?
Yeah, you kind of touched on it that obviously there's banks and then online lenders. And I think we feel strongly that banks are still the most trusted source, for credit needs. And so really by providing different channels like Centime, it only made sense for us to do. And so, I think I saw somebody ask that, do we consider themselves an online bank? And I wouldn't say that. You're backed by, again, the bank's resources where we can give well-priced credit solutions and flex to your needs. So yeah, excited to be partners with you and excited to get this rolled out and help growing businesses.
Awesome.
Yep.
Yeah, let me launch a poll real quick and then BC, you can go a little bit deeper on this, but lots of folks asking me about the next poll. So let me go ahead and launch that. And that question is just, do you have a reliable source of working capital credit that you can lean on? Do you have something like this that can get you through in the event of a crunch? But I'll leave that up for a second, and BC, you can keep the convo going.
Yeah, I think that I just wanted to summarize, right, by kind of just really saying that, always I'm sensitive to turning this into a complete sort of, advertisement for Centime, and I guess I have already done it. But the point is that, what we've tried to do is to bring together these elements of managing cash and ensuring that you keep you maintain visibility and control over your cash and working capital in the way that Chris talked about. How much cash do you have? How do you manage your receivables so that you can collect on time? How do you manage your payables so that you can focus on your days payables outstanding? And then how can you tap into credit when you need it? There's no requirement that all of them be used, but any one of them may be appropriate based on your sort of particular situation.
Awesome. All right. Well, so I think we're going to wrap up.
Oh, I should say one other thing. I'm sorry to interrupt you, but I want to go back to what Philip said, is that I don't want to leave out the fact that we have also worked with FNBO to create an account diversification solution so that, if it turns out that you need to be able to, raise the FDIC limit from the $250,000 to something much higher, we have a mechanism to be able to do that as well. So yeah, that's something that we've partnered very closely with FNBO on.
Cool. Did you have any other slides before I transition to my final slide, BC?
I think that's it. That's what I've got.
Perfect. All right, let me share mine then. I will flip over to me for sharing here. So just a quick offer before we transition over to the audience Q&A. I do want to remind everybody to please submit your questions in the Q&A section is easier for me. If you can put it there, then everybody can vote. So try to put it in the Q&A as opposed to the chat. But before we transition over to that, just want to put out an offer. If any of this was of interest to you, we do have a special offer just for attendees here today, which is that we'd love to treat you to a virtual coffee date. You can meet with a Santeam expert to learn how to take control of your cash. We can give you a demo of anything that you're interested in seeing from today. So AP and AR automation, cash flow forecasting and scenario planning, our credit solutions and diversified banking that BC and Carrie just talked about. And in exchange for that, we'll send you a $10 Starbucks gift card. So lattes are on us. And in order to sign up for that, you can go to Santeam, that's CENTIME.com/coffee. This is valid for US-based companies with at least 25 employees. If you do book it by June 6th, we will send you that gift card. So happy to treat you to coffee for taking the time with us. So with that, I think we're ready to transition over to the audience Q&A. I'm going to end the poll we just had, and then I will throw up one final poll, which is not required for CPE, but if you want to let us know if you're interested in learning more about any of these solutions for cash flow forecasting, AP, the banking solutions, any of those things, let us know that in the polls, and we'd be happy to send you a little bit more information on those things. All right, so let's go for some of the questions that we have in the Q&A. So let's go to, all right, so Henry has a question for BC, and that is factoring considered a viable option for you in terms of a strategy for preparing like this?
I mean, I think it's probably more for Chris to answer. I mean, I'll just say from a Centeam standpoint, we have not incorporated a factoring facility into our solution, but whether factoring is right or wrong for you, I think it's above my pay grade. I've never been CFO anywhere. And so it's up to you, Chris, to answer that question.
Yeah, it's certainly on the menu of options, I would say, right? So, and we didn't get into the specifics of credit facilities, but certainly in the SMB landscape, I found that a lot of credit facilities are secured and most typically secured by ARs. So while that's not factoring, it's in that kind of same family as using those assets to draw on capital quicker than you would otherwise collect on them. So I would say, yes, that is certainly an option. It just may be a little more involved and complex than a more standard receivables-based credit facility.
I'll just say that, the data from the Federal Reserve Bank's small business or the business payments, business credit survey, they list 7 different types of lending solutions. The top choice is loan line of credit, about 76%. The bottom choice is factoring, about 4% of businesses favor factoring. Again, probably because of what Chris mentioned, but also probably because of the cost associated with it. These can be expensive, right, Chris?
Yeah, and I would think the larger the business, the more negotiating power you would have over the cost of factoring and the like. So again, I think that's, factoring is probably, I don't know this for a fact, but I would guess that it's more prevalent amongst larger companies.
Got it. All right. Well, Michelle would like to know, and anybody can jump in on this one. So as a solution to the $250,000 FDIC limit, her bank suggests they enter into a repurchase overnight sweep program where they invest it in government-backed securities for 24 hours. Any downside to this? Anybody want to raise their hand for that one? BC, thoughts?
I mean, I'll say it's interesting that they would ask to do that. I think the key question here is, do you need to? I mean, there are simpler ways to get over the 250K limit. And I think one of the attendant issues that has come up in the last sort of couple of months is also really the idea of not only getting an account that covers you to a higher amount, but also having better yield. So I would say that, I can't specifically answer the question on the downside. I can't imagine there's a downside, but I'll just say it seems more complex than it needs to be.
I think Philip raised your hand. You got thoughts?
Yeah, just really quickly on that. If you are invested in government securities, even at the very short end of the curve, which is often what they do, I think they usually do bills on that. It is somewhat sensitive to interest rates. Now, not much. It's not like investing in a 10-year government bond, but every bill, bond, everything that the federal government issues is somewhat sensitive. I wouldn't say that should put you off doing it. It's probably a better solution than not having any insurance. But I think I'd agree with BC that if there are simpler solutions, they'd probably not have that same sensitivity to interest rates. And it's a very low sensitivity for bills. I want to just stress that.
Okay, so this one I'm guessing would go to Chris. Would improving your AR DSO wind up hurting you when looking for credit if it's based on receivables, or would you look for other lending bases at that point?
I know it shouldn't hurt you. And, this gets into one, it's what's best for the business. And when you think about the priorities and cost of capital, getting the incremental cash from improving your DSOs is always going to be preferable than paying a bank for that, right? So what you're giving up in potential availability in your credit line, you're kind of gaining by a cheaper form of capital. So I certainly wouldn't worry about that. And then depending on how it's structured, I mean, the way a lot of these credit facilities work is that they will actually not let you borrow against receivables that are aged over a certain period of time, right? So like if your business's DSOs are at 40 and you improve that to 35, it may be the case that the bank is only going to lend you against your receivables that are inside of 30 days. So in some instances, you probably have your cake and eat it too. But I certainly, priority one should be driving the operational improvement and getting DSOs as low as possible, as opposed to optimizing for maximum capacity under a facility.
Okay, awesome. BC, to your point about their simpler solutions than the government-backed securities, Henry wants to know, what is the simple solution to the 250K ceiling?
So, Centeam offers a capability as part of our banking solution, where essentially what you do is you move the money into this account, and essentially the excess, anything over $250,000 will get swept into a network of about 3,000 banks. And no individual bank will maintain a balance of, I'll say another way, no individual account, all individual accounts have up to $250,000. In other words, you move your money into this account, we will look at it, and at the end of every day, the money gets swept out from that account, to this network of banks. The result is that in aggregate, I think the maximum is about 140 million as opposed to 250,000. And that's how it gets done. It all sort of happens behind the scenes. And it's something that we have worked with the First National Bank of Omaha to create. Some people call this a cash sweep account, but that's what we have done. The flip side is also true, right? If it turns out that there's an invoice that's presented, a payment that's to be presented against that account that draws on it, and the money is swept in to honor that particular payment. So it's a sort of a two-way sweep, but it's a wonderful product because it's sort of completely transparent. In addition, it also solves the problem of not problem, but it also provides a higher yield. It's a higher interest account. It is a full sweep account. It insures you to the tune of 140 million. It's part of our banking suite.
Yes, and it's very simple from the user's perspective, right? Because it's just a single account that you're working from. So
exactly.
Okay, and so this is probably the last question we can take is, how can a business apply for that short-term line of credit that we talked about from Centeam?
Yeah, so it's done from within the Centeam product. So you register within Centeam and you fill out an online application. A lot of the information is pre-filled. We package that, we send it over to our bank partner, FNBO. They have, we have worked very closely with them to ensure that this is sort of completely transparent. And the decision is typically a 2 business day decision, and you're notified right online as to what your decision is.
Love it. All right, well, I think that wraps it up for our questions. Another way to learn more about that, again, is the coffee offer that I shared earlier. So sonteam.com/coffee if you want to get a demo of this or speak directly to a representative from Sonteam, that's the easiest way to do that. So we did it in exactly 59 minutes. So thank you so much, panel. And thank you, audience, for taking time out of your afternoon, morning, depending on where you're at. So again, thank you, panel. Thanks for joining us. And we will be sending out a copy of the recording, the slides, and more information to those who requested it very soon. So thanks again and have a great afternoon.
Thanks. Bye-bye. See you. Thanks, everybody.
Everyone.
Thanks, guys.